Hello there, and welcome back to my YouTube channel. James here as ever for today's very important ACCA video, especially if you're doing the financial accounting, that's the F3 or the F paper for your upcoming examination. My name is James, I'm an ACCA qualified member from the UK, and my YouTube channel is set up especially for ACCA students around the world who are looking for insights to help them with their upcoming examination, and it's 100% student-led. So, as you can see at the bottom, Prakash, one of my subscribers, has kindly left a message requesting more F3 videos. Well, today I'm going to take you through, for your upcoming exam to help you out, the External Examiner's Report from the September 19 to August 2020 document that you can access online for free. What I've done for you is I've put that document and the link to access it in the description of this video, so click on it so when we go onto the main screen you can follow it through, take down some notes with my insights, and that is definitely going to help you pass this examination. If you'd like access to all of my free videos, feel free to subscribe as well, the button will be down there. Also give it a massive like as well so other students around the world will be able to see this video. So without any further ado, make sure you've got that document loaded up. We're going to head over to the main screen now. I know the video may be a tad long, but we've got to go through Section A, Section B, loads of examples, examiner's insights as well. So hang around all the way to the end and trust me, treat it as a sort of mini lecture on there and it was definitely going to pay dividends for you. So without any further ado, 3, 2, 1, go. Okay, so this is the External Examiner's Report for September 19 to August 2020. Again, the link is in the description below. You can access this for free, and we're going to go through this now, top to bottom, with my insights on here as well. So look, we've got examples on here, Section A, Section B. In other words, if you're doing the financial accounting examination, this is the document you need to be reviewing top to bottom. But as ever, I can hear you from the other side of your screen going, James, look at all this. There's so much to digest on here. I think we've got about 10 pages to get through. Oh my word, how are you going to break this down? It really doesn't look that appealing. Do not worry, I've got you sorted, because there we go. That is what we're talking about in terms of it. So this is my External Examiner's Report analysis, top to bottom. And again, make sure you get any screenshots on here, take down any notes, and this is also going to link into some of my other videos on the channel, so make sure you go and check those out. I've also put some other links in the bottom of the description, so go check them out, all relating to the financial accounting examination, how to pass, other resources on there for you. So let's start to work it through. Stay with me on this, really important stuff. And as you can see, there are a lot of notes to get through. So make sure you give a massive thumbs up to the video so that more students will see these resources on there. So just to walk and talk it through to begin with, again, I'm at the bottom, all the key information is at the top. So feel free to pause it, play it back, whatever works best for you. So this is a computer-based examination, and again, you just need over 50 to pass. I get this question all the time. Obviously, you're going, we only go for 100%, 99% at the minimum on the channel, but 50% to pass. These tips going through here are that is going to make you one of the 7 in 10 who pass this examination. So it's really key that you understand that 3 in 10 will unfortunately fail, but the tips as we go through this video, as I said, will mean that you are not one of the 3 in 10. You get 2 hours to do the examination, so 120 minutes, and that is for 100 marks. So give or take, it's going to be 1.2 minutes per mark, so that you need to be doing practice questions 2 times in your revision. But I've also done a top tips video as well, how I would actually break down those 2 hours so you effectively use it and you minimize the actual amount of mistakes on there. But that's another video. We're focusing on this, so let's get stuck in, because the marking team have kindly pointed out what the strengths were from students, the weaknesses, and in every single external examiner's report review that I've done, constructive advice. In other words, wasn't very good. We're not going to tell you it wasn't very good, but either way, we're going to point it out for you so that we can go through it. Now, if you want to actually get a note down on your folder, on your notes as we go through, the knowledge from this examination links into the F7 or financial reporting examination, so you'll do further on, along with SBR. So if you're starting to struggle on them, bring out these notes as well. And if you've got one of those examinations, these points in the video will definitely help you, especially with the standards. So just to walk and talk you through, we've got two sections in this examination in the general comments to start us off. Section A is 70 marks, and that's broken down with 35 questions, all 2 marks each. And these are called OTQs, or objective test questions, as you can see on here. But the main thing to get down is a broad range of the syllabus topics. And looking through past papers, it's so far and wide that on this examination, being honest with you, you could be tested on absolutely anything. They've pulled out random questions from random pieces of the actual syllabus, and there are some that are more sort of, oh, you're bound to see it on there. But we're going to come on to those further down. But make sure you get jotted down, because it's a computer-based examination. You need to know the type of questions you're going to be asked. So multiple choice, multiple response, number entry, or multiple response matching. And we're going to be going through examples of this further down below. So plenty to get down as a result. And this is where we've got to actually put on here, you're not going to be asked to insert any text in section A. It's just identifying is the key thing on here. But when we come on to section B now, so this is 30 marks, as you can see on my notes on the side, and that equates to give or take about 36 minutes. Whereas up at the top here, 84 minutes, so an hour and 24 minutes for section A, as just a rough guide on there. So what are we looking at as we go through? Well, we've actually got MTQs on this, as the external examiners refer to it, or multitask questions. And get down those notes on the side, because it generally consists of, for section B, the profit and loss, so the income statement, statement of financial position, also known as the balance sheet, statement of cash flows, statement of changes in equity, bookkeeping, and interpretation. So a bit of ratios in there as well. But the key things to get down with your notes is understanding the key topics on there, but then application as well. And we're going to come on to examples that the external has kindly provided for us. So taking those financial accounting skills and going into more depth. Or in other words, section B is harder than section A, but it's mainly all about the financial statement preparation for a limited company, sole trader, and they've also tested in the past parent companies as well. Parents, subsidiaries, associates are very key to get down for section B especially. So as we'll nicely roll it on through now, we've got comments, and this is where you need to start splitting your notes up. Section A, this is what it relates to, and then we're going to come on to section B later. So classically for section A, make sure you get those steps 1, 2, and 3, knowledge and understanding, the underlying principles and concepts, and then how does it apply to the financial accounting module. That is the essence of section A, and we're going to go through a few questions now as we go through the actual document as to how it's been tested before, where are we applying that knowledge, and then what are the tips and tricks to actually pick up in these questions on top of it. So coming on to question 1, and this was an example of multiple choice, so we touched on that at the start of the video, but as you can see here, you've got to be asking yourself the question, what are the key elements within the requirement that I need to be picking up on, and what's it actually relating to on here? So straight away, I'm going to go to the requirement, which was, which of the following are adjusting events? The key reason there being that on some of these questions, they say, well, are they actually or are they not? And some of them are, some of them are not. So if you misread the question, then you're already off to a bad start. So we're looking for are adjusting events in accordance with IS 10 events after the reporting period. So we've interpreted the question, events after the reporting period. So let's go back up there to DEF Limited prepared its financial statements with a reporting date of, key thing there, 31st of March 2003, on the 27th of May 2003. So after the year end, the financial statements were authorised for issue to the shareholders. Okay, so we know the year end and we know when they were actually issued to the shareholders, which was after that. Now we've got to go through the actual points 1 to 4 on here and basically say to yourself, first of all, I've got to read it through carefully, understanding where those dates come into it, break down the answers, and in some cases students prefer to do a timeline so they know where the event is falling. So we've got on the 2nd of April 2003, so after the year end, a customer owing $10 million as at the 31st of March had gone into liquidation. Okay, so date, key term, liquidation on there. Number 2, a fire, key term, on the 10th of May 2003, destroyed a substantial amount of inventory. Okay, keep going through it. discovery on the 11th of May 2003 of a material fraud in the payroll department that had overstated salaries for the year ended 31st of March 2003. The fraudulent activity, that was the key element in the question, had been going on for 18 months. Then we've got finally at the bottom the settlement of a legal action. So key term on there, against Def Limited on the 31st of May 2003, so again after the year end, a provision of $12 million had been made on the 31st of March 2003, and the case was settled for $15 million. So you've got to say to yourself, well, which of the following are adjusting events? So if you want to pause the video as well, have a little estimate to yourself, which one would you actually go for? And again, we've not gone down to the multiple choice. So give yourself a test. Which one would you actually select? Or is it more than one? Start to work it through, because it is good question practice as well. But let's take it down now as to how you should go through this and how you should interpret, especially for IAS 10, because it's been tested before and it will be tested again. So the key questions to ask yourself to start off with, well, do the events actually happen after the 31st of March 2003 or whatever year end you're given in terms of the question? So that's the first thing you've got to get down. Then, are we provided with any new relevant information? Well, they're in the requirements that we've been through, but highlighting those key terms. Does this evidence relate to the reporting period, or is it maybe the next period, or was it a previous period? You've got to go through it. Would it have a major impact on the financial statements? Now, that is one of the key things you have to ask yourself. Well, is it adjusting or is it not? And then finally, 5, how do we deal with this? Do we disclose in terms of it? Are we going to be adjusting? This is where we're going to work it through at the bottom. You can see some of my notes poking through along with the actual answer on here. So just to be crystal clear, the correct choice is number 2, or in other words, items 1 and 3 only. So the adjusting events, so which of the following are adjusting events, were the liquidation and on here the fraudulent activity. So 1 and 3. But then you've got to ask yourself, well, why was this the case on here? So let's pull up on here. So now, for anyone who's not watched one of my videos before, I'm only interested in the key facts and the key figures as we go through. What is the external trying to tell us from this question, as they're stipulating it could possibly coming up again, or where students made mistakes in the past. And straight away in the first paragraph on here, apply their knowledge to the IAS 10 was the key thing here. And for a bit of exam technique, look at each scenario in turn to determine if it's an adjusting event and should it be made. So that's why I said earlier, pause the video, have a go at it, see what you come up with, because we're going to go through it as well. So you might as well have a try. That'll be the same for the other questions going through. So as you can see on here, we're going into more of the details now, where we look at what was the impact. Again, draw a timeline so you can actually see where the events happen and how substantial they are. So events 1 and 3, we're looking at the ones that were adjusting now, occur after the year end, so step 1, back up there, and provide additional evidence of conditions that existed at the reporting date. So what we're saying there is we didn't know about it at the year end, but we do now as a result. So for event 1, the conditions were that the cause for the customer to go into liquidation. So you've got to think that liquidation happens loads of time in advance. They were likely to have been there for some time, that things usually sort of subside off in terms of it, rather than just being an overnight, oh, here we go, we're off into liquidation. Event 3 has caused a misstatement, so this links in a bit to auditing as well, but for the basis of financial accounting, we don't need to go into any audit practices, but it's a key word to make sure you get down in terms of material misstatement as well. In the financial statements that the fraud has happened for 18 months and has now been discovered, so this is the impact. So needed to adjust for both the current and the previous years. So think about it like that the 18 months straddles over 2 financial years, so it's definitely going to be impacting not just on this year but the previous year. So we're going to have to adjust for that as well, because it has caused a misstatement within the figures. We're now going to either be overstating or understating. It's going to mislead the stakeholders of the financial statements. So now you said, well, yes, they're the reasons why it's an adjusting event, but look at the ones why it isn't. So this is where you eliminate out which answers are going to be true on it. So event 2 is not an adjusting event for the conditions of a fire on here. So yes, it occurred after the reporting date. So key thing on there, but it should not be disclosed. So, oh, sorry, this should be disclosed, should I say? I'm trying to read one line to the other, as it is likely to be material on there. So it's not a misstatement that we had as before, but think about it on there. We've had a fire. It's going to be impacting on the actual business itself. It's going to disrupt it in future processes. So we've got to disclose that as a result on here. Drawing a timeline will actually help because it'll impact on the 2004 financial statements if you wanted to go into a bit more detail. We've got event 4 on here, so event 4 is not considered to be an event after the reporting period as per IS 10. The legal case was settled on the 31st of May 2003, which was after the accounts were authorised. So that is where a timeline will really help in terms of picturing what is happening at certain points in time and again justifying it as a result. So that was question number 1 on there. Events after the reporting period and actually identifying and eliminating potentially right examples. So you can see on here we've got example number 2 now, and this is an example of number entry, so a different test for section A, so we're getting a bit of a flavour for it as well, especially if you've not done any of the practice tests. So we'll just walk and talk it through. You should be able to see the answer, but again, pause it if you want to. We're going through it. So Lloyd counted his inventory on the 30th of December 2001 and it is valued at 24,000. On the last day of trading, so 31st of December 2001, he ordered a bit of inventory worth $2,400 and it's to be delivered after the year end, okay? So think about it like this. You've got 30th of December valued, 31st of December, the year end, and then the actual inventory is delivered after the year end on the 1st of January 2002 and made a cash sale at cost of $500 of inventory. Okay, so you've got to be very careful upon the wording there. So read it back to yourself. I've just gone through it as if I'm walking and talking it through, but we've got to look at what is the value of the closing inventory to be shown in Lloyd's financial statements for the 31st of December 2001. Okay, so what is required and at what date? So 31st of December 2001, we know we've got an event afterwards, but just be careful of the wording up there as well. So you can see on the screen here, we've got the correct closing inventory balance should be 23,500. Now the mistake which people will have made on this, especially from reading it through, is have a look at the requirements. So it says on the last day of trading, 31st of December 2001, so that's in the year end, he ordered the inventory and they then made that cash sale. So it's going to be reducing that closing balance on there. That was likely to be missed. So you've got to be so careful when reading the requirement and understanding what fits into what piece of the timeline. So let's go through the actual comments below. So on this question type, candidates are advised to ensure they are correctly type their answer into the number entry box in the format required. Critical point there, as you can see by my note on the side. The thing I want to highlight on here is the 23,500 because some boxes actually have 3 zeros on the end. So I can sort of wave my mouse on here. So they have 3 zeros upon the end here, and it would be, well, that would cancel it out, so you'd have to put the number in the box. So say for example the answer was 24,000 and we had 3 zeros at the end there where my mouse was. All you would put into the box is just 24. If you put in 24, that is the correct answer. If you put in the full 24,000, the computer system that marks these papers would unfortunately mark it wrong. So make sure you get that down as an exam tip. I mentioned it in my tip video as well. That is absolutely critical, and external examiners always point that out as mistakes that are made. As you can see on here, we've talked about it in terms of the figure for the 24,000, but there was no purchase or an invoice for the event that happened for the order on the 31st of December. So we needed more detail in terms of it, but the key thing on here was, in terms of revenue recognition, that the goods were not received within the year. Okay, the goods were received after the year end, so hence therefore an adjustment is not required for that. The sale for that 500 was made in the year, okay, so before the 31st of December, but the goods were not received until after the year end. That was the critical thing, not to include it. So, plenty of notes to get down there. Been through the first two. As you can see on here, coming thick and fast, but I've got to take a step back here because unfortunately, and I don't know how to make you aware of this, but you can see on the notes on the screen, there was an error in this actual document. I've let ACCA know so they can go through and correct it. I've corrected it for you guys out there. So just make a note because it will say on your document 2008, but it should say 2006. What I'll do is I'll roll it down so you can see why on here. When we come on to the actual answer and analysis, as you can see on there, that is where it says 2006 down here, but in the question we had 2008. So really key that you get that down just to make an adjustment for it. I've let them know, but we're going to carry on either way. That you can see now the previous year, the 2006 on the right hand side, I've got that little arrow on there so that my eyes are looking to actually go from right to left to say, am I in a better or worse situation from what the requirement is asking for me? So identify the previous year, what is the current year, and obviously your examination is going to be spot on in terms of this. I think it's just a typo going through it. So let's go through the actual requirement on here now. So which two of the following statements are correct based on the financial information presented? Okay, so in other words, from the financial information you've got above, which of the statements below are actually true? And there are two of them on there. So I've kindly highlighted them for you on here, but what would be my sort of key questions you've got to ask yourself as you go through? So make sure you've got those jotted down on the side there as to, well, what are the key terms in the actual question itself? And how does this link to the information above? So when you read through points 1, 2, 3, and 4, how does that link into the actual current assets and the current liabilities? So let's just go through it now. So the cash position, I'll leave it on there. The cash position is improving partly due to Hold Steady Co. paying creditors later in 2007. Okay, well, looking at that, we think creditors, what's another word for that? Trade payables. So creditors, make sure you've got that circled on there. I'm going to put the actual statements at the top now for you. You can see it a bit better. So Hold Steady Co. may be experiencing rapid growth. So growth is definitely the key one on there, which is causing it to run out of working capital. So in other words, I'm thinking there, well, cash is going down, inventory is going down. Let's have a look at the actual bits on here. Well, cash has definitely gone down. Inventory has actually increased a bit on there. But then we've got to be thinking, well, are we actually increasing our payables? But it's saying here experiencing rapid growth. So that is true because our cash is depleting, so we needed to use our cash to actually function, and our trade receivables are increasing. So it's actually indicating that we've got more and more customers, and we're trying to finance that by a bank overdraft, I would say. So just try and think about it logically as you go through. Liquidity of Hold Steady was shown to be improved in 2007. Well, I can tell you now, well, in terms of liquidity, which was the key word, the cash balance has gone from 6,000 to naught, and you've gone into an overdraft. There's no chance in that being true. Notice how I'm trying to eliminate it as we go through. And finally on here, Hold Steady has a net cash outflow of 10,200. So net cash outflow, well, that's got to be relating to the actual cash and bank account balance and the overdraft. But we're going to come on to that in the workings below. So just so you're crystal clear, points 2 and point 4 are the true ones as well, but we're going to go into a bit more detail now below as to why that is the case. What was the actual exam technique that you can take on board from this, from the key terms on here? So just make sure you get down that this was an actual multiple response question so that you're getting a feel for all the different types of question you could be asked for. And the reason why I walk and talk it through is that's the sort of technique that you need to be implementing in your exam technique for eliminating and just saying to yourself, that can't possibly be true. So that is, well, 3 out of 4 can be right here. And let's go and eliminate another one. So the key terms to get down in terms of this, that we had working capital decrease on there. We've got to identify the key terms. So we've got growing on there. We identified the cash reserves going down. So in essence, it was a case of the cash versus the overdraft in terms of the net cash outflow. So take the minus 4,200. We also had the balance that started off as positive 6,000. It went down to zero. So that is another decrease as well. Hence the 10,200 as a result on there. Coming on to the point of the company growing, so this is the case of trade receivables going up, inventory going up, trade payables going up, and the cash balances being used to actually function the business. So that would actually indicate that it is true that we're expanding, we're utilizing as much cash reserves as possible to actually put into practice the actual business model because we've got such high demand at the moment. So that's where you've got to interpret the figures and not just take them on face value as well. So it comes with practice going through, but hence the reason for the videos and the detail, I would say, going through it. So that takes us through the reasons why they are correct, but we also walked and talked through actually why the others just couldn't possibly be true. And there's so much exam technique going through here, and as you can see, the 2006 note on the bottom, bad note for ACCA, but we'll let them off, it's okay. So options 1 and 3 are not correct, but even the external examiner is trying to get across to students of the FA paper, it is worth considering why this may be the case as well, why they can't possibly be true, okay? Because you're saying, well, these are the ones that are right and these are the ones that are wrong. So that's really key exam technique going through. And first of all, we've got a comparative analysis. So for option 1, clearly incorrect, as we said, because the cash position has just not improved. Cash has gone down dramatically and we've taken on that overdraft. So how can you say that the cash position has been improving? Then it goes on to saying whole study no longer has cash at the bank and is using the overdraft. Correctly pointed out as per the examiner, and we've walked and talked it through. So take that technique, analyze it, make sure we understand what was the current year and also the prior year as well. That is going to make us a world of difference in terms of, because that is another area students make mistakes on this examination, analyzing the figures the wrong way round. Option 3, as we can see on here, the key word on here was actually relating to liquidity. So I've got it down on the notes on the side. If you hear liquidity straight away, you do think about the actual current ratio. So we've actually done some of the calculations on here to say, well, in 2007, the current ratio was 1.2 to 1. Or in other words, what we're saying there is there's $1.20 to $1 in liabilities. So that's the ratio of $1.20 in current assets to $1 of current liabilities. And if you compare that to 2006, as they had down here, it was 1.86. So what we're saying there is we're actually in a worse situation. So the calculation confirms that the liquidity has not improved as a result. The higher that figure compared to 1, the more cash we have available as a result. There are arguments, obviously, to say if you've got too much cash, maybe you should be investing it. But the key thing here was that they were trying to argue that the liquidity was actually not improving on there. So the calculation confirms liquidity has not improved, and we've justified it as well. But picking up on liquidity in the question was the key element here. So let's keep on working it through. And example number 4, again, pause it, have a go through yourself, see what you make. This is a multiple response question on here. So another classic exam question, the external examiner and also in the technical articles that are available on ACCA's website highlight this kind of multiple response question all the time. So first of all, I've got on the side there, the dates are critical, so that before we've even had a look at the requirement, we're going to get an understanding of what is going on and getting out of our mind the dates from the previous question to now focusing on the dates of the example in front of us. And Non-Yong produced the following information concerning its expenses for the year ended 31st of December 2006. So we're using different dates compared to the previous questions. You've got to get in the habit of forgetting about them, or it could actually make you actually get the wrong answer for the next one. We need to go clean slate and to start again. So we've got the balances as at the start of the year. So the 1st of January 2006 is the first day of the year, and the year end is the 31st of December 2006. And what we've got here, we've got some accruals and prepayments at the start of the year, some cash has been paid throughout the year, and what we've disclosed in the statement of profit and loss at the end. But let's have a look at the requirement on here, what it's actually asking for, and it's saying which two of the above will be included as liabilities. So the key word on there, liability, someone who we are going to owe money to. So it's not an asset in the statement of financial position, so within the balance sheet, and we've got to identify two of them that are going to be liabilities. In other words, who we still owe money to. And the four options on here, when I first read this, I thought, so many students are going to be tricked by the actual wording on here because they'll see the words payable, so rent payable, service agreements payable, and that'll automatically tell them in their minds, well, I've seen payable, that links into a sort of creditor, so those two are probably it. That I bet you any money that's the first thing you thought when you went through this. But as you can see on here, the correct answers are 1 and 4. But the other thing just to get down in your notes is that even if you'd have only got one of these right, it wasn't a case of you needed both of them to get the 2 marks. If you identified stationery and put rents payable, well then you'd have actually got 1 mark on this as well. So a really good point there just to say, well, it's not doom and gloom if you get one of them wrong and you miss out on the complete 2 marks. They're being generous on here, and if you get one of them right, then you still get 1 mark for it. So we've got the analysis on here, I'll be honest, in terms of it. And when I read it through, I thought, that's going to be a tricky one to explain as we go through. So you've got on here the accruals and prepayments, and depending on which sort of textbook you're using, and I put in the links below, textbook I recommend as well, but whichever one on here, I'm going to explain it to you either way, because there are T accounts on here. So these are the figures which we're going to come to. But I'm just going to walk and talk you through up at the top, and we're going to come down to the answers. So when I had a look at this up here, you've just got to say to yourself what is going on in this situation. And again, links back to that timeline to say, well, the 1st of January 2006, start of the year, we'll take stationery as the example. You've got an accrual of £3,000. So we owe £3,000. So think about it, minus 3,000 to start off with. We then make a payment of £12,000, okay? So that's positive £9,000. You'd agree with that, okay? Then you've got to say to yourself, well, we've paid £9,000 throughout the year, but then you've got to say to yourself, well, what have we actually claimed for the year? And that relates to the statement of profit and loss. What figure have we got in there for our actual expense? And this is where you've got to say to yourself, well, we've paid, the balance is now 9,000, but what we've actually claimed in the profit and loss is 10,000. So I had down there minus 1,000, nice and easy, as an accrual at the end. It was a negative. Walk and talk it through to yourself for rents payable, the service agreements payable, and telephone. Exactly the same process, but we'll do a prepayment on here now. So we'll look at telephone, which was the other right answer. So at the start of the year, it's positive 1,000. Okay, nice and easy. We've made the prepayment from the previous period. We've brought it forward, and then you've got to say to yourself, well, what have you paid in the year? The 8,500. So that's positive now, positive 9,500. And well, what have we actually claimed for in the income statement or the statement of profit and loss? Well, we've claimed for 11,000, but we've only actually paid 9.5. So wouldn't you agree that we now owe 1,500? So just remember those figures on the side there. We've got 1,000 for an accrual. We've got 2,000 in terms of a prepayment, 500 for another prepayment, and a 1,500 accrual. So we're going to go down to the answers that the external gave to us. But for me, personally, that was a far easier way to go through it. That there's our 1,000, there's our 2,000, there's our 500, and there's the 1,500 on there. Nice and easy, but make sure you've got down on there that a prepayment is a current asset that is of value to us, whereas an accrual is a current liability and we still have it owing. And it's just walked and talked through the exact same figures, but just in a different layout. I've tried to use the requirement, keep it nice and easy, try to do it as if it was in an exam situation, because for me personally, that's a lot of workings and a lot of time. You've got to get better and faster going through these questions. But it's going to come with practice, but take that technique, apply it to different questions. It's going to save you time and you're going to get more right answers from it. But the key thing on here was, as you can see, I've highlighted prepayment and accruals. We had to pick up on liabilities in the question and knowing that an accrual was a liability, because there were, as you know, two assets for prepayments and there were two accruals for liabilities. And if you didn't pick it up on it right, maybe you just went with the payables amounts that we saw in the question. I'm afraid nil point on that one. But let's keep working it through because we've now got a multiple choice one on here. And feel free to pause it, as I said, going through it. We're getting a wide, diversified amount now in terms of different types of question choices. There are other questions on ACCA's website as well, but let's walk and talk this one through. And this is a case of classic example where the external examiner has tested this before, multiple choice, where you've got to really understand this question. Read it through to yourself really carefully that the receivables ledger control account of the business showed a closing balance for the year of $420,000. Okay, so that's the year-end balance. But this did not agree with the total of the list of individual receivables ledger balances at the year end. So we've got a discrepancy in terms of the figures. Subsequent checks revealed the following. So in other words, we've got 420,000 is our figure, but it isn't the correct figure. We're going to have to work back, okay, in terms of this, where the sales day book has been overcast by $15,000, okay, so there's an overstatement there. We've got too much in terms of the value. And then we've got a debit balance that has been extracted from the sales ledger of 10,000, okay, and has been incorrectly recorded in the list of balances as a credit balance. So in other words, we've got an amount, and what we've done is we've increased it by 10,000. So it should have been minus, so that would be 10,000 the other way. So there's actually a 20,000 gap, but I'm going to come onto it at the bottom. I'm going to walk and talk it through, keep it simple as well. But I've just put on there, we've got the ledger versus the list, just to start us off. We've got a credit that should have been a debit, and we've got an overstatement as well. They're the key notes. Comes up on this question, as we know, and it comes up on so many others that you need to be identifying. Let's have a look through, because this is the requirement on here, that what was the total of the list of the individual receivable ledger balances before the errors. So the 420 is after the errors. We now need to work back on those two transactions to come to the right figure. And as you can see on here, it's $385,000. But you've now got to ask yourself the question of, how do I get there? That is the key thing. So let's go through it down below. These are the key workings that you need to be familiar with on here. So this is, and the external examiner's even trying to hint you on here, read between the lines, this is a typical exam style question of the syllabus area in terms of, my thing's fallen off, it's fallen off. Picking up, everyone. Well, I'm gonna carry on regardless. I'm hoping it's all right for you. I'm hoping it's all right in terms of it. This hasn't gone well, has it? Oh no. Well, as ever, we are highly professional on here. I'm really sorry about that if that's sketchy. But back to the question, because, well, it's a lot of time to do this. So we're going to keep going through it. That this is a typical exam style question for the syllabus of errors, okay? It's that important. My laptop nearly fell over recording this as well. So in true fashion, we will carry on professionally as ever. To the correct answer to this question, candidates are advised to record all information, okay? As we go through, the key thing here is get down with an errors question, you've got to work backwards. Or in other words, that 420,000 is after the errors, as we said. We're looking for what was the actual figure before the errors. So an important exam technique is missing balances, its errors as we go through. And I'm going to walk and talk you through how I would approach this. You've got the full answers in front of you, but this is the key thing on here, as to say, well, how are you going to explain it to yourself? So first of all, we've got to go through point one, then point two, then we're going to get the answer. So as you can see on here, the key thing is the correct balance on the receivables ledger account. So we've got the 420,000. As we said, it's overstated, isn't it? That 420,000 is too much. So we've got to reduce it down by the 15,000. So that gives us our now correct closing balance of 405. So I'm hoping that is crystal clear in terms of it. Then we've got the second one, as to say, well, the opening total of the list of balances was not correctly done in terms of it. So this is the way I sort of worded it versus what ACCA have got it on here. So first of all, they've got it as sort of what happened in terms of it. So as I said, it was credited and increased. So what happened was it's taken the amount and increased it by 10,000. But what should have happened to get the correct balances from that amount, we should have reduced it by 10,000. So looking at ACCA's example on there, that's what the 20,000 comes into it, but it doesn't quite give it to me in enough detail personally as to, well, what does it actually mean that we needed to debit it by 10,000 to decrease it and needed to be reversed. So as you can see on my notes on the side there, I'd have had it down that, well, we're actually at 395. We then should have reduced it down by 10,000 as a result, and that would have given us our 385 on there. So it's just a different way of thinking about it. You've got two examples on there, and we're back to being professional now, working it through with my light not falling off on me. But, you know, it's proper stuff. It's getting going through it. And so there were no other notes for example 5 on there. So that's just working backwards, classically tested, and I'd put money on them testing it again. Even though it comes across quite simple, only 2 little transactions and adjustments on there, but it is all about just working it through, understanding what's happening, overstatement, and getting it the right way. Okay? So coming on to example 6 now, we've got number entry on here. So Principal Co has a financial year end of the 30th of June, and we've got 2006 to 2007. So again, pop that arrow on there because then we've got to focus on current year and the prior year as well, so we don't get these mixed up. And I'm thinking on there, we've got loans, ordinary shares, so capital structure, all on the balance sheet. And we're going to go on to the requirement, as you can see on here. So what have we got? So it's asking what is the net cash inflow from financing activity. So this relates into the cash flow statement in terms of it from that particular section. If you want to get that down as a little note for the year end, the 30th of June 2007. So in other words, at 2007, has the cash flow been going up or going down? We've got to work it out. And we've got another note on there to say a rights issue took place during the year on the basis of 3 shares for every 2 held on the 1st of July 2006. So at the start of the year, at a price of $2.50, should I say. Well, that's start of the year, so no apportioning in terms of it, but we've got loan notes and we've got some share capital and share premium. So we're going to have to break this down one by one in terms of it. So the first thing I'm thinking there is, it's a case of, well, the loan notes have gone up, so that's definitely a cash inflow for it. But let's go through the actual answer and we'll walk and talk it through on here. So the correct answer that we're looking for is 960. And I thought this was quite cheeky in terms of the actual examiner, but they actually put this was a relatively straightforward question covering IAS 7 in terms of it. But I just put there, do you agree? Viewers, should I say, with the external examiner's comments at there. Well, feel free to leave it in the comments below with obviously any feedback from the professionals of the video as well. And yes, let me know what you think. But for me, keep it simple. It's 3 steps, nice and simple. The first one we alluded to as to that loan balance. So we'll bring it up to step 1, as you can see on the side notes. That is a cash inflow. It's simply gone from $490 to $700,000, and you've got to say to yourself, well, yes, the loan has increased. That has increased the amount of debt, but a bank has had to pay us that amount, so it's going to increase the amount of cash flow for the year, $210,000. So that's the first step. Then we're getting into a bit more trickiness in terms of dealing with that share capital, share premium, and there are 2 methods of going about it. Whatever works best for you. I think for me, I'd probably go with the top one, to be honest, in terms of it, because all it's simply saying there is, what was the share capital in 2007 minus what we had at the start of the year 2006. Same with the share premium, and that gives us a positive cash flow of $750,000. You have also got the alternative one on there as to say, well, you've got the 200,000 opening shares, so at the start of the year, and then going to do your fraction for the 3 for 2. multiplying it by the $2.50, which was the actual market value at the time. You're going to get the same answer, and then finally, step 3, adding the two together to get the total of $960,000. So that is really key as a result from that. No, not too bad in terms of, but a bit harsh from the external on that, I'd say. Oh, bad mark in my eyes. But let's have a look now. So if you want to split this off now, as a result, we're looking at Section B's performance. So we've done Section A, we've gone through all the different types of questions now. Now getting on to Section B, so this is all to do with the actual accounts, income statement, balance sheet, cash flow, statement of changes in equity. And as you can see, my little note on the side there, testing financial statements, ratios, and partial accounts. They're your 3 overview topics you've got to get down on there. Highlighted in the first paragraph on there that with a company, it's either going to be a single company or part of a group. We're going to come on to more details on that below. But with Part B, you're actually required to actually provide answers with this. So it's not just a case of select these options, here you go. You've got to show some workings with some answers, and it is more critical, and it's a harder section, this bit is as well. Ratios on there, again, highlighted within this first paragraph. So the external examiner is trying to tell you in this paragraph the 3 elements that going into the examination, you have to be confident on those 3 areas, or you're going to be going in at a disadvantage. So let's roll it through because there are elements on here that are linked to the computer-based format as a result. So these are the sort of aspects that from an exam technique point of view, we've got number entry, pull down menus as well, and multiple response matching. So there are some elements in here, but you're also going to have some calculations as a result. This is all for the computer-based format, so you can actually do practice questions online from this. I've done a CBE video on the channel as well, so check that out, because this is another element where the 3 in 10 will unfortunately fail the exam because they have not prepared effectively for it. They turn up at the exam, they think they can work the system, and they actually start wasting time, which 2 hours sounds like a lot of time, but it goes very, very quickly. Now, it's nicely actually broken down into some nice and easy sections on here. So the first one all relates to single entity financial statements, and it doesn't say this on here, but from reading it through and analysing it myself, it all comes across as how to improve in your performance for Section B, especially below. And the first paragraph on there, it is advised that you'll become more familiar with the presentation of financial statements on there. And this is absolutely fundamental for your notes because it's the expectation of the examination that you're not expected to actually present the full financial statements top to bottom. You may be asked to actually insert text. So we've got on here, you will not be asked to insert text to construct the statement of profit and loss or statement of financial position, but you may be required to determine the correct position of a ledger balance. So whether that's in the current assets, the equity part, whatever it may be, profit, loss, costs, and identifying the correct titles. So balances titles on there, what you need to do for it. It's basically presentation tips, but what it's saying there is you're not being asked to construct the whole thing as a result. So make sure you've got that jotted down to go with your revision notes. And as ever, classically with this style of question, coming into it later on into the exam, students are bound to make loads of mistakes on it, so always read carefully through the information. Q&A, if you're an hour and a half into an examination, more and more students are bound to make more mistakes, and again fall into that category of the 3 in 10, unfortunately. So we've got an example on here as to where are the key areas that the external is trying to point out to you that going away from this video, you need to be having a look at. So do each of the following items belong to the statement of financial position as at the 31st of October 2007? So in other words, yes or no as we go through. So you've got to be selecting yes or no from it, understanding and the detail going through it. What does it mean was the key thing. Ask yourself, talking yourself through, and just think about it logically from a balance sheet, income statement perspective, single entity company. So we've got some reminders on here from the external examiner of key topic areas. So double entry, debits and credits, balance brought down, balances brought forward, carried forward amounts. Those are absolutely fundamental. Next key things to get down here are the two depreciation methods. So I'll put some little notes on there for you that I would highly recommend getting down, because that is going to explain it to you nice and easy. That we've got the straight line method where it's simply the same each year. So I've just got a nominal amount of 80,000 on there over a 4-year period. So it's going to be 20,000 each year, classically done over a number of years, round figures. Whereas the reducing balance method, so 25%, I've done it in terms of a percentage, the same 80,000, and multiplying something by 25%, as you know, is the same as dividing by 4. So the charge is the same in the first year, but have a look at the second year, because the value of the asset goes down to 60,000. We then have to reduce it down by the same amount, but look, it goes down to 15,000. So you can see now how that same asset, if they'd have used the straight line method, it would have only been worth 40,000. But if we use the reducing balance method, we've got £35,000 worth of depreciation as a result on there, and it's worth 45,000. So different values as a result. And finally, at the bottom, we've got on here, this question style really focuses on your understanding of the accounts preparation. Key thing, get it down. Double entry as well, debits and credits system. So numerous practice questions are essential. In other words, it's probably going to come up. So if you're not prepared for it, you might have to wave that white flag, I'm afraid. That'll be it. The next key element on here, we've got the statement of cash flows. Please make sure you've got down in your notes on here, operating, investing, financing. Then mention about the headings up above. You could be tested on it. Those are the 3 key headings from a cash flow statement. But what could be asked for? So we've got number entry, drop down, lists. So those key headings could be in there as well. It's important that you know the format of it, opening and closing balances with those 3 headings, and what goes on in those 3 areas. So operating classically is what goes on in the business on a day-to-day basis. Investing, on the other hand, is to do with the capital structure. So equity is famously found in there. Whereas finally, financing is all about the sort of non-current assets. Are we buying? Are we selling? And that's where it's coming on about, well, generating economic value long-term for the business. But as we go down on here, and this has come up before in other documents and especially in other articles, negative is bad for cash flow. So we've got add and subtract on here. Common mistakes again. If you see an amount in brackets or negative, that means it's bad for cash flow. If it's a positive number, then that is good for cash flow. Making sure you don't get this mixed up is absolutely critical to passing this examination. So make sure you get that down, because the external examiners mention it again. They've said add and subtract, and then they've put back to front. So it's a common mistake. It's been tested before. I've seen it on past exams. It'll get tested again. We've got to actually know how to calculate tax and dividends paid, so within the actual cash flow statement. So the external examiner, again, is being specific. Tax and dividends, cash flow statement. Have a look at some past paper questions. Make sure you're comfortable on it, because they've directly highlighted it in only 3 bullet points for it. And be careful with the impact of the profit and loss on disposal. So this is where I've got some other little notes on the side there to say, break down the transaction. And this is the same for, these are notional amounts that if you make a profit or a loss, depreciation's another one here, that with an asset, it could fall under different areas. So it could fall under operating, it could fall under financing. That I've got it down there for you. You've got the profit and loss element, you've got the cash received element, and you've got the carrying amount element of that asset going forward. So make sure you get those down. That is really going to help you. Next point in terms of it, so section 3 now, we've got the consolidated financial statements. So going into a bit more detail, but again, I'm only highlighting the key terms, the key facts, and the key figures on here, plus how could it be tested. So we've got drop-down lists are the key thing on here with the actual appropriate headings. So you've got to know the format, how it's all laid out. And it's going to be testing you. I've got word testing on there as to say, well, it's single entity financial statements. But they've also hinted at IFRS definition of control. So if you own over 50% of a company, you become the actual parent, you have control of the actual business itself. If you own 50% of the ownership, you actually have that control that you can make decisions that influence the business's activities. So going on further down now, so this all relates to consolidated financial statements, so other areas that you could be tested on. So we've got calculating goodwill, certain aspects of that on here from the statement of financial position, profit and loss, but calculating relevant balances, so they mention it up above, they've mentioned it again, relevant balances are going to be key. Or a little thing on the side here, which they didn't really mention up above, but selecting the appropriate formula. So that could relate to the accounting equation or potential ratios as a result on there. And mentioning further down as well, other key areas on here, so important areas for the consolidation of statement of financial position. So now being more specific to a particular financial statement. We've got the assets, the liabilities of the parent and of the subsidiary. So if you're a subsidiary, the parent owns more than 50% of the company. So in other words, parent, subsidiary, the parent owns at least 50% of that company. Nice and easy. But what it means is, in terms of the actual statement of financial position, is if you have a subsidiary, you add all the assets together and you add all the liabilities together on a line-by-line basis. So if that was the, we'll keep it consistent. If that's the parent, that's the subsidiary. These are the financial statements. Okay, non-current assets, add them together. Current assets, add them together on there and work your way through current liabilities, non-current liabilities. But the key thing on here is it's not the same for associates. So an associate is between 20 to 50% in terms of it, but you haven't got control. And it wouldn't be done on a line-by-line basis. We've got investment in the subsidiary on here. So when we actually buy and invest in a subsidiary, that then takes us to having goodwill in the calculation, and hence the investment is, well, it disappears upon consolidation, and we're left with goodwill, which, as we know from above, we will have to calculate. What I've done for you on here is another key mistake that is made, and that involves the share capital and the share premium. So remember, that's already been tested in Part A and can be tested now in Part B on top of that. So it's an easy mistake to make. I see it all the time on here, but the share capital and the share premium, so get that jotted down, really key note, are not added together. They are separate balances and only relate to just the parent. Because remember, the parent has full control, so we only want their actual share capital. And I've given you a nice easy breakdown on there that the nominal value of the share capital was £1 per share, and over time the company's performed better, so it's got a share premium attached to it of £5, giving us a total value of £6 altogether, breaking it down just like we saw in the question above. So really good technique to go through. But I've got down here a little example for you as a result. So just put on the example of the parent owns 80% of the subsidiary. So that means there's a 20% non-controlling interest. The subsidiary has profits of £10,000. And what does this relate to? Well, the parent gets the proportion of those profits. So that means that 8,000 is added to the parent's retained earnings. So that links into the group share of the subsidiary's profits. Profit is calculated and added to the group's retained earnings. So a little example on there. I thought we could have gone into a bit more detail. Draw out the group structure, identify the correct percentages, and make your life easier in terms of it. But that's a very helpful example. Remember again, over 50% for the parent, and they have control. So let's keep it going through, nearly there at the bottom, so stay with me on this. And we've got point 4 on here for the consolidated statement of profit and loss preparation. So again, key 4 bullet points on here. Make sure you've got them down because the revenue expenses again are added together on a line-by-line basis for the subsidiary, but it may be time proportion or apportion, so I say, depends if the company was purchased mid-year. If they own the actual subsidiary for the full 12 months, then they just simply get added together. But if it was mid-year, so 6 months in, then we'd apportion that by 6/12 because we've only owned it for half the year. The key thing on here is anything that happens between the parent and the subsidiary, and these are called intragroup transactions. So whether that's sales, purchases, and you've got it on here for unrealized profit. So in other words, the subsidiary selling to the parent or the parent selling to the subsidiary, and these need to be eliminated upon consolidation. Finally, coming on to it at the bottom, so we've eliminated all those intragroup transactions. Finally, we've got to ensure you know how to calculate the profit attributable to the controlling and non-controlling interests of the company. So I thought we need more detail on this. That one sentence will just not do. But the easiest way to get this, as you can see on my little example on there, is, again, I'll walk and talk you through it. It's a case we've done the income statement, we've come to our profit at the end, which in this example, I've just pulled 950. So you've done your income statement, you've got 900, sorry, at the bottom. Then you're being asked, well, how do we know what relates to controlled and what is a non-controlling interest? Well, the way you break it down is quite simple. It's a case of take the profit of the subsidiary and simply just times it by the NCI percentage in terms of it. So what profit did they make? Multiply it by that percentage, and I've got 250 on there as just an example. So from the 20% that we had above, and well, we've then got a balancing figure that we know it has to be 900 because this is how we're going to make it attributable. Obviously, it would be more ideal to go through a question, but time is upon us. And the group share of the profit is the balancing figure, so that actual 650 on there. So I've tried to relate it to the points above, and again, we're just only able to take the profit of the subsidiary multiplied by that NCI percentage. Keep it simple for yourself, but see my videos on the channel for other updates on this. I'll probably be doing more on that as a result. So the examiner's finally taken us to a little conclusion at the end there, again highlighting that it's imperative to study and prepare well on all topics. You've seen that on section A, it's been highlighted now about 3 or 4 times that if you don't have adequate knowledge on all the topics, then there'll be some things that you just won't have come across and basically not likely to get the marks on it. And it's students who don't go through all those topics will be falling into the 3 out of 10 that will unfortunately fail this exam. So in order to maximise and improve performance, make sure you're going through them all. Try and attempt as many questions that you have, whether that's in the textbook, there are actual practice tests that I've got on there available on ACCA's website, but they are at a charge, so whatever works best for you and within your budget on there. Only when you've completed the whole syllabus shows areas of weakness at the end of the computer-based examination. So I had a bit of research on this online. You can attempt the CBE and it will tell you at the bottom which areas you need to actually improve on and have a look back into your core text. So make sure if you're going to buy them and go through them, actually do them at the end. So maybe a week before the examination, maybe 2 weeks, I'd say, actually, to be safe, because then you can focus and home in your revision techniques on there. Final notes at the bottom from the actual Q&A on the ACCA's website and from the technical articles that it's obviously come up quite a lot that IFRS 16 on leases is not tested on this examination. So get that down because it seems to come up loads of times, but it is tested on financial reporting and SBR. However, IFRS 15 revenues from contracts with customers could be tested in how to account for sales. So we've actually seen a bit of that in this document as well. And finally on here, there is no own figure rule for the computer-based examination because questions are more specific in terms of it, and is not really set up to actually benefit from this. That's more you go into other foundation papers as a result of it. And relax. And we're there, even with a little malfunction, but we can't stop on that. Well, that is how you go through top to bottom the external examiner's report. Let's head back to the main screen. Final points on there, and 3, 2, 1. Wow. Prakash, what did you think to that? That, in my eyes, is how you should be going through and taking down lots of notes from an ACCA external examiner's report from head to toe with my insights as well. That is definitely going to help you and any other fellow students as well with your upcoming ACCA examination for financial accounting. So if you know any friends who are also studying this examination, ping this video over to them. It is definitely going to help. If you'd like access to all of my free videos, feel free to subscribe. The button will be at the bottom, and give it a massive like as well so that other ACCA students around the world will be able to see this video. Well, the last thing I can say is best of luck with your upcoming F3 or FA paper for financial accounting. These tips are definitely going to help along with all the other videos on my channel. But as always on that bombshell, I'll see you next time. Cheers!